is how Australian expats with an investment property in Australia can save tax before 30 June. In this example, we have an Australian expat with an investment property in Australia that's generating rental income of $50,000 per year. They also have rental expenses totaling $40,000 per year, which they can claim as a tax deduction. So that's going to give them a taxable income in Australia calculated as $50,000 less $40,000, which gives us $10,000. Now that $10,000 is subject to foreign resident tax rates, which start at 30%. So as a result, that Australian expat would pay personal tax of $3,000. Instead, if that Australian expat contributed $10,000 into their Australian super fund and claimed it as a tax deduction, that would reduce their taxable income to zero and they would pay no personal income tax. Now, what happens to that contribution to super is it's taxed by the super fund on your behalf at concessional tax rates. Now, that concessional tax rate is 15%. So that contribution of $10,000 would be taxed at 15%, resulting in tax of $1,500 being paid on your behalf. Now, as a result of making that $10,000 contribution to super, this person would have saved $1,500 in tax, which is the difference between the $3,000 and $1,500. And that's just a really easy way that Australian expats can save tax by making a contribution to their super fund before 30 June.